We've started to see the pullback we've been expecting and talking about in these videos. So things are going according to plan thus far, but we're about to enter a new year, and I'm going to be gone for the holidays from tomorrow until January 1st. So let's start talking about that new year, how we're positioning going in, and what our expectations are as the calendar turns to 2023. We expect that this pullback will continue to new lows. There's a few reasons for this. One, yields are quite low. The Fed has said specifically that the market is underpricing the risk. The Fed is going to be more hawkish than they expect. They said this before the last FOMC meeting. We saw what came out of the FOMC meeting. We've heard from Mary Daly, who's typically, San Francisco. You would expect a little bit more on the dovish side. She seems very much in the pack of the hawkish chorus. We're starting to see the economy begin to weaken, but it's much later than it should have been. So it's hard to say if rates are going to get to a new peak, if they're going to really get all the way back up there. But there's reason to believe they can't go much lower. And we're starting to see that activity today. 11 basis points on the 10-year. It's a move. That's a move. 3.4, 3.5. We got to 3.6, I think, at one point. We might get there tomorrow. We'll see what happens. But last week we saw the market pull back with rates low. Today we saw the market pull back again and rates were up. So the market seems to be recorrecting its valuations. 2023. There are stocks I want. If you've been watching this channel long enough, you know I've been bullish. I've been a tech investor. I bought speculative archetype stocks. I'm not a total bear. That's not my thing. My thing is not being a bear. My thing is not being, expecting higher energy prices in perpetuity. My thing is focusing on price for what I'm getting, focusing on fundamental factors, and focusing on cash flow, and just adapting with reality. That's what we try to do. So there will be a point that we want companies that will produce income for us. However, I think we have a ways to go, and I'm going to provide an example. I'm just going to talk broadly for a minute. When we buy a stock, it's important to remember we're putting cash down in order to get cash back, in order to get at least value back, an asset. A lot of people have been, and the market, this is not calling anybody out, I'm talking about the market as a whole. This is objectively true, obvious if you look at the charts, and even if you want to get specific into different names. People have been buying an idea, not a cash flow, not assets. They've been buying an idea. Oh, that's a good idea. I'm just going to throw cash at the idea. When you buy an idea, you don't value the future cash flows properly. That has happened broadly throughout the market and has led to quite tremendous valuations and quite tremendous prices. There's one name I do want to buy. It's Adobe, ADBE. This is a stock I think should be able to produce relatively stable cash flows, be relatively predictable, and offer some semblance of growth. It's an interesting business I'm personally interested in, product I use, and a product I believe in. It has all the makings of a stock I want to own. However, it's still missing, despite its most recent pullback, on one very crucial aspect, and that is price. The stock is trading at 30 times earnings. That would be okay if the company was trading, getting a call, swiping it away. If the company was trading, or growing rather, 30% per year. Yeah, I would give it a premium because I would expect that PE to come down over time just based on the fact that the earnings are growing. However, that's not the case. The earnings aren't growing very much. They just bought a tremendously expensive business, Figma, overpaid tremendously for that. But if somehow the Figma deal doesn't go through, if the stock pulls back down to around 18 times earnings, or that Figma deal ends up being better than I think it is, that's the type of company I'll want to buy. So when Adobe gets to 20 to 18 times earnings, assuming the Figma situation is not a total catastrophe, I will go in and buy that stock. But I'm talking about this to illustrate that this stock is down tremendously. However, it's still too expensive for me to give my precious capital up and buy this asset. That's just the way it is. There are lots of businesses I want to own. I want to own Apple, but I want to own Apple at 14 or 15 times earnings, not at 23, 22, 24. So just because stocks are down does not mean it's a buying opportunity. I know it makes it easier to pull the trigger, but just think about it in the sense that you're giving up money and you're expecting money back. So when you're doing that, you want to get a price that makes it look like you're actually going to get some money back. Not that you're paying to wait 30 years from Adobe to get your money back. 30 years is a long time. You can buy a bond at 10% from Boeing or a cruise line or something like that and get a return like that. So, and, get your money back. It's the whole thing. So I say 2023 plan. We like energy still. It's well priced. It cash flows. It pays a dividend. It's got good fundamental factors. We're sticking there. We're sticking long. We got the shorts. We got some short stock. We got a lot of options. Those options we're just going to let expire. We're going to sell. We did some trimming. We're trimming the nearer term stuff first. We'll occasionally just take a nibble out of a long one that gets too big. But into 2023, until the next video, we're going to let things just play out. We're going to see if the market keeps pulling back. If it does, we'll let these positions ride and not get too greedy. We'll take some off the table every now and then. We're going to let things ride. Once the market is down to a point where I feel like Adobe is buyable, I will buy Adobe stocks. Right now, it's not. It's too expensive, and they've got this weird Figma deal that is too expensive. So, I know it's not a very specific plan. It involves a lot of waiting and seeing, but be on your toes. Understand that there will be a time to buy. Ooh, light just went out, but it's not here yet. The prices in various stocks are still too expensive. I would love to own Union Pacific, railroad company. I would love to own Waste Management, garbage disposal company. These are important companies that will be around forever, that provide a valuable service and generate cash flow. But that time is not yet. These are still very expensive stocks. Even Waste Management, 30 times earnings. It's a great business. It's very solid. It's going to do well in a recession. I would feel confident as an employee of that company, or as a CEO of that company, or as a founder who still had shares in that company, although I might sell some because the market's paying me more and I might be able to buy some more later. But the price, like I said, too expensive, too high in various areas. In 2023, we're staying short. We're remaining in our shorts. We're remaining long energy. We've got one or two other bets like Jumia still on the books. And when the prices get ready or get low enough, we'll buy. We're not, I just want to clarify, we're not super always bearish. There will be an opportunity for us to buy. Whether that's in 2023 or 2024, we're going to have to see. The prices are going to dictate that. We'll see what happens. That's today's video. Happy holidays, and see you on the other side. Peace out.